The device you're watching this on right now contains a component manufactured in one place on Earth, Taiwan. The phone in your pocket, the car sitting in your driveway, the laptop you use for work, the medical equipment at your local hospital, the defense systems protecting your country. Every single one of them runs on semiconductor chips that can only be produced at scale in Taiwan. If that supply stops tomorrow, the impact isn't just geopolitical headlines, it's financial devastation measured in trillions. I'm not predicting this happens next week. What I'm telling you is that markets are currently priced as if it never happens at all, and that gap between actual probability and current pricing is where fortunes get destroyed. 3 weeks ago, on December 29th and 30th, 2025, China conducted the largest military exercise around Taiwan in over 3 years. They named it Justice Mission 2025. 130 aircraft sorties, 14 warships, 15 Coast Guard vessels, live fire drills, rockets launched into the Taiwan Strait for the first time since 2022, simulated blockades of Taiwan's major ports. This wasn't a hypothetical scenario in a think tank report. This was rehearsal. And the exercises focused on one specific capability, the ability to isolate Taiwan economically without firing a single shot at a building. No invasion required, just pressure, insurance premiums spiking, shipping delays, airspace restrictions. The kind of gray zone coercion that doesn't trigger military alliances but absolutely destroys global supply chains. Bloomberg Economics puts the total economic damage from a Taiwan conflict at $10 trillion. That's 10% of global GDP. Greater than the 2008 financial crisis and COVID combined. And almost nobody's portfolio is positioned for it. Let me walk you through exactly what happened 3 weeks ago. December 29th, 2025. China's People's Liberation Army Eastern Theater Command announced a large-scale military exercise surrounding Taiwan. They deployed ground forces, Navy, Air Force, and Rocket Force units simultaneously across 8 designated zones encircling the island. The stated objectives were specific: sea and air combat readiness patrols, seizing comprehensive superiority, blockading key ports and critical areas, and for the first time publicly, deterring external intervention forces. That last part matters. China was sending a message not just to Taiwan, but to the United States and anyone else who might consider coming to Taiwan's defense. On day one, Taiwan's defense ministry tracked 89 Chinese military aircraft operating around the island. 67 of them entered Taiwan's air defense identification zone. 14 warships took positions. 14 Coast Guard vessels began patrols. An amphibious assault strike group consisting of 4 ships positioned itself in waters southeast of Taiwan. By the end of the 2-day exercise, Taiwan confirmed 130 total aircraft sorties. That's the highest number recorded during any single exercise since China began these drills in 2022. But the aircraft weren't the headline. On day 2, China fired rockets into the Taiwan Strait for the first time since the 2022 exercises that followed Nancy Pelosi's visit. Taiwan's Ministry of National Defense reported 27 rockets launched into waters north and southwest of the island. Some landed within 24 nautical miles of Taiwan's coastline. That's approaching Taiwan's contiguous zone, the 12 to 24 nautical mile buffer surrounding territorial waters. Chinese state media didn't hide the purpose. They released footage showing simulated strikes on land and sea targets. They published detailed coverage of blockade operations targeting Taiwan's 2 most critical deep water ports, Keelung in the north and Kaohsiung in the south. Those 2 ports handle the majority of Taiwan's imports and exports. Block them, and you choke Taiwan's economy without setting foot on the island. The China Coast Guard conducted simultaneous patrols around Taiwan's outlying islands, Kinmen, Matsu, Wukyu, Pratas. They released maps showing patrol routes that came within 1.3 nautical miles of Matsu and 1.6 nautical miles of Wukyu. Both distances put them inside prohibited waters. This wasn't symbolic posturing. This was a live demonstration of capability. 857 international flights were affected by the exercises. 84 domestic flights within Taiwan were canceled outright. Over 100,000 travelers faced disruptions. Routes to Kinmen and Matsu were blocked entirely, stranding approximately 6,000 people. Think about what that means. China demonstrated it can disrupt civilian aviation and shipping around Taiwan whenever it chooses. Not through war, through exercises. And here's what should concern you most. This was the 8th major military exercise China has conducted around Taiwan since August 2022, each one larger and more complex than the last, each one practicing the same core scenario, isolating Taiwan from the outside world. The exercise areas during Justice Mission 2025 covered more territory than any previous drill. The coordination between Navy, Air Force, Coast Guard, and Rocket Force was more sophisticated. The messaging about deterring foreign intervention was more explicit. President Trump said he wasn't worried. China's been doing naval exercises in that area for 20 years, he told reporters. That response misses what's actually happening. These aren't routine naval exercises. These are rehearsals for a specific operation. and the frequency is accelerating. China conducted 274 aircraft sorties into Taiwan's air defense identification zone in December 2025 alone. 125 of those occurred during the 2 days of Justice mission. When the actual pressure campaign begins, it won't feel like a dramatic escalation. It will feel like Tuesday. Because China is normalizing its military presence around Taiwan right now, making the world accustomed to seeing Chinese forces operating in those waters constantly. By the time markets react, the disruption will already be underway. To understand why those military exercises matter beyond geopolitics, you need to understand what Taiwan actually produces. Taiwan Semiconductor Manufacturing Company, TSMC. As of January 2026, TSMC has a market capitalization of $1.7 trillion. That makes it the sixth most valuable company on the planet, larger than the entire GDP of most countries. TSMC doesn't design chips, it manufactures them. And it manufactures them for nearly every major technology company in the world. Apple, Nvidia, AMD, Qualcomm, Broadcom, MediaTek, Intel, Google. Every single one of them depends on TSMC to produce their most critical components. TSMC controls between 64 and 71% of the global foundry market. That's the market for contract chip manufacturing, where companies design chips and outsource production to specialists. But market share alone doesn't capture the concentration. Taiwan produces over 60% of the world's semiconductors. When you narrow that to advanced chips, the ones below 5 nanometers that power artificial intelligence, smartphones, and high-performance computing, Taiwan's share rises to 92%. 92%. TSMC alone produces 90% of the world's most advanced logic semiconductors, the chips that power ChatGPT and every other major AI system, the chips inside the latest iPhones, the chips driving autonomous vehicle development. One company, one island, 90% of the world's most sophisticated manufacturing capability. In 2024, Taiwan's semiconductor industry generated $165 billion in revenue. That represented a 22% increase from the previous year, driven by surging demand for AI chips. That $165 billion accounts for more than 20% of Taiwan's entire GDP. One industry, 1/5 of the national economy. Let me show you how concentrated the customer base is. Apple has been TSMC's largest customer for over a decade. In 2025, Apple accounted for approximately 20 to 25% of TSMC's total revenue. The company spent roughly $24 billion at TSMC last year. That's 12 times what Apple spent with TSMC in 2014. Apple doesn't just buy chips from TSMC. Apple funds the development of new manufacturing processes. When TSMC launches a new chip generation, Apple typically takes more than 50% of initial production capacity. In some cases, Apple has taken nearly 100% of early supply. The relationship runs so deep that TSMC's founder Morris Chang once said he'd bet the company on Apple back in 2013. He committed $10 billion to build manufacturing capacity on the promise that Apple would fill those factories. He was right, and that bet created the foundation for TSMC's current dominance. But Apple's position is shifting. NVIDIA is now challenging Apple for the top customer spot. In at least 1 or 2 quarters of 2025, NVIDIA may have already overtaken Apple in revenue contribution to TSMC. Industry analysts expect NVIDIA to definitively surpass Apple sometime in 2026. The reason is artificial intelligence. TSMC's revenue from high-performance computing, which includes AI chips, climbed 48% in 2025. That followed 58% growth the year before. High-performance computing now accounts for 57 to 60% of TSMC's total revenue, up from 30% in early 2020. Smartphones, Apple's primary category, have dropped to a secondary growth driver. Every NVIDIA H100 and H200 AI accelerator is manufactured by TSMC. These are the chips training large language models, powering data centers, and driving the AI investment boom. NVIDIA occupies more than half of TSMC's advanced packaging production capacity. AMD relies on TSMC for its processors. Qualcomm relies on TSMC for its mobile chips. Broadcom, which is rapidly growing its AI business through partnerships with companies like OpenAI, relies on TSMC. The customer list reads like a directory of the technology industry's most valuable companies, combined market capitalization in the trillions of dollars, all dependent on production from a single island. There is no alternative supplier at this scale. Intel has its own manufacturing facilities, but Intel has struggled to match TSMC's production capabilities at the most advanced nodes. Intel is actually a TSMC customer now for some of its products. Samsung operates foundry services in South Korea, but Samsung's market share sits around 11 to 13%. Samsung has faced yield problems at advanced nodes that have prevented it from capturing more business. Chinese foundries are growing, but they remain generations behind on technology and face export restrictions on the advanced equipment needed to catch up. The global economy has built its entire digital infrastructure on a supply chain that runs through one company on one island that China claims as sovereign territory. TSMC's chairman C.C. Wei addressed this reality at an investor conference in January 2026. He said the company will continue developing its most advanced technologies in Taiwan because of the need for intensive collaboration between research teams and manufacturing operations. The expertise cannot be easily relocated. The supply chains cannot be quickly replicated. The concentration is structural, not accidental. And that concentration is exactly what makes Taiwan valuable and vulnerable. Semiconductors aren't one industry. They sit inside every industry. And let me show you how the cascade works, starting with the sector that already experienced what chip disruption looks like. Automotive. The average car rolling off the assembly line today contains between 1,000 and 3,000 semiconductor chips. Industry data puts the typical figure around 1,700 chips per vehicle. These chips aren't optional accessories. They control critical systems, engine management, transmission control, anti-lock braking, airbag deployment, power steering, climate control, infotainment systems, navigation, backup cameras, parking sensors, tire pressure monitoring. Every major system in a modern vehicle runs on semiconductors. Electric vehicles require even more. Battery electric vehicles need approximately 3 times more semiconductor content compared to traditional combustion engine vehicles. Battery management systems, power regulation, energy optimization, regenerative braking, thermal management. The semiconductor value per electric vehicle now averages around $1,500. That figure is projected to grow as vehicles become more sophisticated. Advanced driver assistance systems push the requirements higher. Lane keeping, adaptive cruise control, automatic emergency braking, blind spot detection. Each feature demands additional processing power and sensor integration. The average semiconductor value per car was $759 in 2024. That's expected to reach $130 by 2030. The number of individual semiconductor devices per vehicle is projected to grow from 824 to over 1,150 in the same period. Now here's why this matters for a Taiwan scenario. We've already seen what happens when chip supply gets constrained. Not stopped, constrained. 2020 to 2023. The global chip shortage. COVID disrupted manufacturing. Automakers canceled chip orders early in the pandemic, expecting demand to collapse. It didn't. When production restarted, semiconductor factories had already reallocated capacity to consumer electronics, smartphones, and data centers. The automotive industry found itself at the back of the line. The results were devastating. In 2021 alone, more than 9.5 million vehicles of global light vehicle production were lost as a direct result of semiconductor shortages. The third quarter of 2021 saw the largest impact, with an estimated 3.5 million units cut from production in a single quarter. Another 3 million units were impacted in 2022. The shortage cost the global automotive industry approximately $210 billion in lost revenue in 2021. Some estimates put total losses even higher. Before the pandemic, industry forecasts predicted global vehicle sales and production would exceed 100 million units annually by 2022. That milestone is now not expected until after 2030. The growth trajectory was thrown off by roughly a decade. Ford parked thousands of unfinished vehicles at Kentucky Speedway, not because they lacked engines, not because they lacked interiors, because they lacked chips. Picture that. Fully assembled vehicles sitting in a Speedway parking lot, waiting for components worth a few dollars each. Without those chips, $50,000 trucks couldn't be completed, couldn't be sold, couldn't generate revenue. Some automakers found cars sitting in lots with everything ready except a single chip controlling a critical system. Power management, display controller, safety module. The specific chip varied, but the outcome was identical. The vehicle couldn't ship. Toyota planned to cut worldwide production by 40% in September 2021. General Motors halted production at nearly all North American plants for 1 to 2 weeks that same month. Stellantis paused production at multiple European facilities. During the third quarter of 2021, new car sales in the United States dropped to 2/3 of the prior year level. Not because consumers stopped buying, because dealers had nothing to sell. Lead times for semiconductor orders went from 3 to 4 months under normal conditions to over a year during the shortage. Automakers couldn't plan production cycles. They couldn't fulfill customer orders. They couldn't project revenue. Used car prices spiked as a result. New vehicle inventory collapsed, pushing buyers into the secondary market. Prices increased more than 10% in some markets during 2021. The microchip shortage cost the United States economy an estimated $240 billion in 2021 alone. And that was a shortage. Supply was constrained but still flowing. Chips were delayed, not absent. Factories eventually caught up. Production eventually recovered. A blockade is different. A blockade isn't delay. A blockade is absence. Taiwan accounts for 92% of leading-edge chip manufacturing. Those are the chips that power artificial intelligence, cloud computing, 5G networks, advanced weapon systems. If those stop flowing, you don't wait longer for delivery. You don't get alternatives, you get nothing. Automakers would face an impossible choice. Build vehicles without certain features and retrofit later, which some attempted during the shortage, or halt production entirely. Either option destroys margins. Either option destroys revenue. Either option means layoffs, plant closures, and cascading failures through the supply chain. The 2021 shortage removed nearly 20 million vehicles from global production over 3 years. Analysts kept predicting the crisis would ease. Late 2021, early 2022, mid-2022. They were wrong each time. A Taiwan disruption wouldn't follow that pattern. There would be no easing, no gradual recovery, just absence that compounds every week as inventories deplete and production lines sit idle. The automotive industry learned in 2021 that it couldn't function without steady chip supply. It spent the years since trying to build resilience, longer-term contracts, closer supplier relationships, strategic inventory buffers. None of that helps if the supply disappears entirely. Automotive shows you what disruption looks like in a sector that uses mature chips, legacy technology, older manufacturing processes. Now consider what happens to the industries that depend on the most advanced semiconductors. The chips only Taiwan can produce. Start with artificial intelligence. Every NVIDIA H100 and H200 AI accelerator is manufactured by TSMC in Taiwan. These are the chips training ChatGPT, the chips powering Google's AI systems, the chips running Meta's large language models, the chips Anthropic uses, the chips driving the entire generative AI boom. NVIDIA occupies more than half of TSMC's advanced packaging production capacity. The company's revenue grew 62% in fiscal year 2025. That growth depends entirely on TSMC's ability to manufacture and ship chips. If Taiwan supply stops, AI development doesn't slow down. It halts. No new training runs for large language models. No expanded inference capacity. No next-generation chips for data centers. The company is currently valued on expectations of massive AI revenue growth. Get repriced overnight. NVIDIA's market capitalization exceeds $4 trillion. That valuation assumes continued access to TSMC manufacturing. A sustained Taiwan disruption doesn't just impact current revenue. It destroys the growth narrative justifying the stock price. AMD faces the same exposure. Every high-performance processor AMD sells comes from TSMC fabs. Qualcomm, Broadcom, MediaTek. The entire fabless semiconductor industry depends on Taiwan manufacturing. Move to cloud computing, Amazon Web Services, Microsoft Azure, Google Cloud. Every major cloud provider requires continuous chip supply to expand data center capacity. Servers need processors. Storage needs controllers. Networking needs specialized chips. Cloud infrastructure spending exceeds $200 billion annually and grows 30% year over year, driven by AI demand. That growth requires chips that come from Taiwan. If supply stops, cloud expansion stops. Companies can't add capacity. They can't serve new customers. They can't support the AI workloads driving their revenue growth. Microsoft's market cap includes enormous AI growth assumptions. So does Google's, so does Amazon's. A Taiwan disruption reprices all of them simultaneously. Now consider Apple. Apple spent approximately $24 billion at TSMC in 2025. The company has secured more than 50% of TSMC's initial 2nm production capacity for 2026. Every A-series chip in iPhones, every M-series chip in Macs, every custom silicon Apple designs, all manufactured by TSMC. Apple's market capitalization sits around $3.4 trillion. Approximately 70% of iPhone production depends on components from Taiwan, not just final assembly. Critical chips for processors, power management, cameras, and displays. A 6-month production halt would be catastrophic for revenue and earnings. Apple can't relocate manufacturing quickly. The supply chain doesn't work that way. The smartphone industry broadly faces the same problem. Global smartphone shipments exceed 1 billion units annually. The vast majority of advanced mobile processors come from TSMC. Samsung manufactures some of its own chips, but Samsung also uses TSMC for certain products. And Samsung's foundry business can't absorb the capacity gap if TSMC goes offline. Here's what makes this different from automotive. Cars use mostly mature chips, older technology, multiple potential suppliers, even if switching takes time. AI accelerators, smartphone processors, and high-performance computing chips use leading-edge technology, the kind only TSMC produces at scale. There's no backup supplier. There's no inventory buffer large enough. There's no alternative. Cloud providers might survive months on existing infrastructure. They couldn't grow. Smartphone makers might ship reduced volumes using existing chip inventory. They couldn't launch new products. AI companies might continue operating current models. They couldn't train new ones. The technology industry's growth assumptions collapse simultaneously across every semiconductor-dependent company. That repricing would be brutal. and fast. Let me put specific numbers to what we've been discussing. Bloomberg Economics estimates the total economic impact of a full-scale war over Taiwan at approximately 10 trillion. That's roughly 10% of global GDP. To put that in perspective, the estimated costs from a Taiwan conflict would exceed the combined losses from the 2008 financial crisis and the COVID-19 pandemic. But you don't need a full invasion to trigger massive economic damage. The Institute for Economics and Peace calculates that a Chinese blockade of Taiwan, not invasion, just blockade, would result in $2.7 trillion in global economic losses within the first year. They consider this estimate conservative. The Rhodium Group, an independent research firm, puts over $2 trillion in economic activity at immediate risk from a blockade scenario. They describe this as a floor, not a ceiling. The full scope of damage would be greater. The Hudson Institute analyzed what losing access to Taiwan's semiconductor industry would mean for the United States specifically. They're finding $1.6 trillion in annual GDP at risk. That's approximately 8% of America's economic output. These aren't hypothetical models built on assumptions. They're calculations based on documented supply chain dependencies. Taiwan produces 92% of the world's most advanced logic chips. TSMC manufactures 35% of global automotive microcontrollers, 70% of smartphone chipsets, dominant shares in graphics processors for PCs and servers. When analysts trace which industries depend on those chips, the exposure becomes clear. Global tech hardware market, approximately $3 trillion annually. Automotive industry revenue, $2.8 trillion annually. Consumer electronics, over $1 trillion. Cloud infrastructure and data centers, $200 billion and growing 30% year over year. Defense electronics across NATO countries, hundreds of billions. Add them together. $6 to $7 trillion in annual economic activity, directly dependent on continuous semiconductor supply from Taiwan. Now factor in the Taiwan Strait itself. The strait is one of the busiest shipping lanes in the world. Nearly 50% of global container shipping passes through these waters. Over $2.45 trillion in goods flow through annually. A military blockade wouldn't just stop chips. It would disrupt one of the world's critical trade arteries. Shipping companies would reroute. Insurance premiums would spike. Delivery timelines would collapse. The disruption would cascade through global commerce far beyond semiconductors. The stock market impact compounds these figures. The technology sector alone represents approximately $15 trillion in global market capitalization. A sustained Taiwan disruption would trigger revaluations across every semiconductor-dependent company. Not because companies go bankrupt overnight, because their growth assumptions collapse. Their ability to deliver products disappears. Their competitive positioning erodes. Investors would reprice every affected stock simultaneously. The selling would feed on itself. Circuit breakers. Limit down days. Panic liquidation. The destruction wouldn't unfold over years. It would unfold over weeks as markets process what supply chain collapse actually means. China and Taiwan together would absorb $1.6 trillion of the blockade impact, according to IEP estimates. But the damage spreads globally. Japan, South Korea, the United States, Europe. Every economy integrated into technology supply chains takes losses. A conflict over Taiwan wouldn't be an Asian regional crisis. It would be a global economic depression triggered by the loss of one island's manufacturing output. And currently, markets are priced as if the probability is zero. I can hear what you're thinking right now. This would hurt China too. They're Taiwan's largest trading partner. Over half of Taiwan's chip exports go directly to China. A blockade cuts off Chinese tech companies from the components they need to function. If China blockades Taiwan, China destroys its own technology industry. Therefore, China won't do it. Therefore, we don't need to price it. That logic is dangerous for two reasons. First, it assumes perfectly rational economic actors making decisions based purely on cost-benefit analysis. But geopolitics doesn't follow market logic. China has demonstrated willingness to accept enormous economic pain when leadership deems it strategically necessary. COVID lockdowns. China maintained zero COVID policies long after the economic damage became obvious. Entire cities shut down, manufacturing disrupted, GDP growth crushed. Leadership accepted those costs. Trade war tariffs. China absorbed significant economic damage rather than capitulate to U.S. demands. They took the hit. Real estate sector collapse. China allowed Evergrande and other developers to fail despite the economic shockwaves. They accepted the pain. The assumption that economic cost prevents action ignores how authoritarian systems actually make decisions. Strategic priorities override economic calculations when leadership believes core interests are at stake, and Taiwan is the core interest. China's position is explicit. Taiwan is sovereign Chinese territory. Reunification is inevitable. President Xi Jinping stated in December 2023 that reunification of the motherland is a historical inevitability that will be achieved. His 2026 New Year's address repeated the message: the reunification of our motherland is unstoppable. This isn't framed as a trade relationship or an economic partnership. It's framed as completing the Communist Party's revolutionary struggle, unfinished national business from 1949. When a government frames an objective in those terms, economic rationality becomes secondary. Look at the precedent from 2022. Russia invaded Ukraine despite obvious economic costs: Western sanctions, asset freezes, trade disruption, energy revenue collapse. Putin accepted all of it. Was that irrational? From a pure economic perspective, absolutely. From Putin's strategic perspective, he calculated that controlling Ukraine mattered more than the economic price. That's how these decisions get made. Not spreadsheets, strategic priorities. If Chinese leadership concludes that the window for reunification is closing, or that Taiwan is moving irreversibly toward formal independence, or that American resolve is weakening, economic calculations become secondary considerations. Markets that price based on economic rationality miss how these decisions actually get made. Second, and this is critical, a blockade doesn't have to be total to be effective. China doesn't need to stop all trade with Taiwan. They don't need a complete naval cordon enforced by warships. They just need to make shipping risky enough and expensive enough that the flow drops dramatically. Insurance premiums spike for Taiwan strait routes. Shipping companies reroute to avoid the risk. Airlines avoid contested airspace. Manufacturers delay shipments waiting for clarity. You achieve 70% of the economic impact with 30% of the military action. And you create ambiguity about what's actually happening. Is this a blockade, or enhanced security exercises, or routine Coast Guard patrols, or maritime law enforcement? Gray zone coercion? Not war, not peace. Something in between that disrupts supply chains while avoiding the clear tripwire of military invasion. Markets have no framework for pricing gray zones. They price binary outcomes: war or no war, invasion or no invasion. The actual risk exists in the middle, and that's exactly where China has been operating for years. The obvious response to everything I've described is diversification. Build chip factories elsewhere. Reduce dependence on Taiwan. Governments understand this. Companies understand this. The efforts are real. They're also too slow. The United States passed the CHIPS and Science Act in 2022. It allocated $52.7 billion to boost domestic semiconductor manufacturing, research, and workforce development. Sounds substantial. But compare it to TSMC's investment plans. TSMC is investing $165 billion globally over the next several years. That includes $65 billion committed to its Arizona complex alone, with plans potentially expanding further. The scale mismatch is enormous. America is spending $52 billion total. TSMC is spending more than that in a single state. And the timeline is the real problem. TSMC's first Arizona fab began 4 nanometer chip production in late 2024. That's already one generation behind the leading edge in Taiwan. The second Arizona fab was originally scheduled for 2026. It got pushed to 2028. Strong customer demand recently accelerated that to 2027. Construction is complete. Equipment installation begins in mid-2026. The third fab broke ground in April 2025. It targets 2 nanometer and 1.6 nanometer technology. Production is expected by the end of the decade, maybe 2028 or 2029 if everything goes perfectly. A fourth fab is in the permitting phase. When the entire Arizona complex is operational, TSMC plans for approximately 30% of its most advanced chip capacity to be located in the United States. 30% by the end of the decade. If everything stays on schedule, that leaves 70% in Taiwan for years to come. And there's another constraint nobody talks about publicly. Taiwan restricts TSMC's overseas operations through what's called the N2 rule. Overseas fabs must operate technology at least 2 generations behind what's available domestically. TSMC is producing 2 nanometer chips in Taiwan now. Mass production ramps through 2026. The Arizona facility just started 4 nanometer production. That's a 4 to 5 year technology gap by design. Taiwan keeps its most advanced capabilities at home. The cost differential compounds the problem. Building a fab in Arizona costs 4 to 5 times what an identical plant would cost in Taiwan. Chips produced in Arizona will be at least 50% more expensive than chips made in Taiwan. Labor is part of it. TSMC faced worker shortages and had to bring Taiwanese engineers to Arizona temporarily. The specialized workforce doesn't exist at scale in the United States. The supporting ecosystem doesn't exist either. In Taiwan, TSMC operates within a dense network of suppliers, equipment providers, and specialized services built over decades. Arizona has none of that infrastructure. Japan is building capacity too. TSMC's Kumamoto fab started production in late 2024, focusing on older 12 to 28 nanometer chips for automotive and industrial use. A second Japanese fab targeting 6 nanometer is planned. Europe has semiconductor initiatives. Intel is building facilities in Germany and elsewhere. But the timeline problem applies everywhere. New fabs take years to build, years more to ramp production, years beyond that to reach meaningful scale. China has a stated target of 2027 for military modernization. That's the date Washington obsesses over. Whether it means anything specific or just represents a planning milestone, the trend is clear. China is building capability, rehearsing operations, normalizing presence. The diversification timeline runs 5 to 10 years. The risk window may be 1 to 3 years. That gap is the vulnerability, and no amount of investment announcements changes the math. During that gap, global dependence on Taiwan remains nearly total for advanced semiconductors. The CHIPS Act helps eventually. The Arizona fabs help eventually. Eventually doesn't help if disruption comes in 2027. Every crisis doesn't destroy everything equally. It concentrates demand. When supply chains break and production halts, certain characteristics become extraordinarily valuable. Domestic production capability. If you manufacture chips domestically and your supply chain doesn't depend on Taiwan, you're insulated from the disruption. Your competitors can't produce. You can. Your relative value explodes. Intel operates its own fabs in the United States. Samsung has facilities in South Korea and Texas. GlobalFoundries runs plants in New York and Vermont. Chinese domestic producers serve their internal market. None of them can match TSMC's scale or technology. But in a disruption scenario, that matters less than location. Their capacity doesn't increase overnight, but their strategic importance does. They become the only suppliers in a market with unchanged demand and collapsed supply. Economics 101. Price goes vertical. Existing inventory. Companies that stockpiled chips before disruption can keep producing while competitors sit idle. Every chip in the warehouse becomes leverage. Every finished product becomes scarce. During the 2021 shortage, companies with inventory buffers maintained production. Companies without them stopped lines. A Taiwan disruption would amplify that dynamic dramatically. Whoever holds inventory holds power. Government demand. Defense contractors with domestic supply chains or existing inventory become critical national assets. Governments will pay premium prices to maintain weapons production. Emergency procurement. Stockpile releases. Cost becomes irrelevant when national security is at stake. Modern weapon systems are semiconductor intensive. F-35 fighters, Patriot missiles, naval vessels, communications equipment, all require advanced chips. If Taiwan supply disappears during a crisis that might require military readiness, the defense industrial base faces bottlenecks at exactly the wrong moment. Companies serving government customers don't just survive that scenario, they thrive. Their valuations expand because they're solving the most critical problem in the economy, pricing power. When supply disappears, whoever still has product can charge whatever the market will bear. Scarcity creates leverage. During the 2021 shortage, chip prices spiked. Automakers paid premiums to secure supply. Consumer electronics faced delays. A blockade scenario intensifies those dynamics beyond recognition. The companies that can deliver become irreplaceable. This isn't about picking specific investments. I'm not recommending anything. But understanding the framework matters. When a crisis hits, you need to know what survives and why. The sectors that survive are predictable once you think about it. Domestic manufacturing, defense and critical infrastructure, companies that already prioritized supply chain security. The destruction falls elsewhere. You can't predict exactly when China moves. Nobody can. But you can watch for signals that markets aren't tracking. Insurance premiums. If shipping insurance for Taiwan straight routes starts spiking, that's real money pricing, real risk. Insurance companies quantify probability for a living. When their models change, something shifted. Flight paths. If major airlines start rerouting around Taiwan, that's operational risk management, not political statements. Business decisions based on internal assessments, TSMC customer announcements. If Apple or Nvidia suddenly announce inventory builds or supply diversification acceleration, they're seeing something. These companies have better intelligence on Taiwan risk than most governments. Coast Guard activity. China conducted 4 patrols into waters around Taiwan's Kinmen Islands in December 2025 alone. The December 25th incursion entered prohibited waters for the first time in over a year. This activity is normalizing. Each patrol makes the next one less newsworthy. That's the point. Exercise frequency. 274 aircraft sorties into Taiwan, and its air defense identification zone in December 2025. 8 major military exercises since August 2022, each larger than the last, each practicing the same blockade scenarios. The pattern is escalation, not de-escalation. Port disruptions. During Justice Mission 2025, China simulated blockades of Keelung and Kaohsiung. If commercial shipping starts experiencing unexplained delays at these ports, something may be shifting from exercise to implementation. Headlines about military exercises come and go. Markets ignore them. The signals that matter are commercial, insurance, shipping, aviation, corporate supply chain decisions. When businesses start pricing risk that markets haven't acknowledged, the gap between probability and pricing is closing. That's when repricing becomes inevitable. The device you're watching this on proves the dependency. The chip inside came from Taiwan. So did the chips in millions of other devices powering the global economy right now. That concentration makes modern technology possible. It also makes it vulnerable. Taiwan is not a risk factor in the global economy. Taiwan is a single point of failure. 60% of semiconductors, 92% of advanced chips. One company producing components for Apple, Nvidia, AMD, Qualcomm, Broadcom, and hundreds of others. There is no backup at scale, not at the technology level that matters, not on a timeline that helps if disruption comes in the next 2 years. We've built the entire digital economy on an island that China claims as sovereign territory and has explicitly refused to rule out taking by force. That vulnerability is so obvious that we collectively ignore it, because acknowledging it would require changes that seem impossible. You can't rebuild decades of semiconductor investment and expertise in months. So markets price Taiwan risk at near zero. And the actual risk isn't zero, it's rising. Those two facts create opportunity for those who position correctly, and catastrophic losses for those who don't. Markets crash because something everyone ignored suddenly matters. Taiwan is that something. The only question is when everyone stops ignoring it, and whether you understand the exposure before it matters or after. After is too late. The repricing already happened. You're watching losses compound while trying to figure out what went wrong. Before gives you options. Not certainty, but options. Understanding which sectors survive, what signals to watch. When the gap between probability and pricing starts to close, the chip inside your device came from Taiwan. So did the future of the global economy, for now.